Hi everyone, it's Jack back with another video. Today I'm going to be talking about the shipping company ZIM Integrated. Now this is a company I've made a couple of videos on in the past. That was mainly because of its absolutely enormous dividend yield. As you can see here, it's currently registered on Yahoo Finance as over 115%. It has paid out in the 70% dividend yield range. It's been absolutely destroyed year to date, right near its 52-week lows after announcing its earnings, where it was down around 15% yesterday. It's down 80% in the past year, way off its 52-week highs of $71, and it doesn't look like getting back to it anytime soon. P/E ratio on a trailing basis is 0.38, but as you'll see from these results, that does not really tell the full story. And despite the massive dividends, and they're trying to clean up the balance sheet a little bit, this business has changed thesis-wise. So let's talk about it. Let's see if it's a buy, sell, or a hold going forward. Here are the financial highlights. Get a bit deeper into them in a minute. Some of these numbers down were to be expected somewhat because this is a relatively cyclical business. Shipping rates in 2021 were just through the roof. Now they're not. This is to be expected somewhat. However, even for the most optimistic of ZIM investors, the missing the guidance like this and these numbers being down as much as they are is worrying. Revenue $1.4 billion, that's down 63% year over year. Adjusted EBITDA of $373 million, that's down 85%, maintaining around 27% adjusted EBITDA margins. Now, I'm not a fan of adjusted metrics, but on an adjusted EBITDA basis, it's a $1.8 billion company. That's relatively cheap on this, but of course, the adjusted is not what mattered. Adjusted EBIT loss, greater than 100% loss, minus 1% adjusted EBIT margins. Cash flow from operations of just $174 million. Now, that puts it at 10 times operational cash flow, which is not overly cheap for this business. 90% down year over year for operational cash flow. Total equity of $5.1 billion. The 2023 guidance continues to be adjusted EBITDA around $1.8 to $2.2 billion. That's 1 times 0.9 times market cap, which is relatively reasonable, but again, it's adjusted. Adjusted EBIT is likely to come in at 100 to 500 million. Net income probably going to be around zero. The real news here, in my opinion, because them recording weak results in an obviously weak time was to be expected. However, ZIM will now not pay a dividend to its shareholders on account of its first quarter results. Its plan is to distribute 30 to 50% of annual net income as dividends, subject to the company's discretion and Israeli law. This was the plan for this year. Now, right now, this is just pretty much impossible because they're recording next to no net income. They need to preserve some cash flow for operations because the balance sheet is less than perfect. So that's 70% dividend. The dividend that looked too good to be true is too good to be true. It was always going to happen eventually. I think a lot of people saw it on the horizon. Some people made off with massive dividends, but right now it's looking like the dividend is going away. Doesn't look like coming back anytime soon, in my opinion. I always think it's reasonably tough to evaluate business like this where external factors weigh so heavily on the business. For carried volume was only down 10%, which is not impressive by any means, but in a tougher environment this is kind of to be expected. For Q1, however, freight rate was down 64% year over year, and that just means that revenue is incredibly impacted. So revenues that 1.4 billion were down 63%. The freight rate was down 64%. There's nothing they can do about this. This is external factors, relatively commoditized industry, and that just hurts the business. And I tend to avoid businesses like this where they're so heavily reliant on external factors out of their control. In terms of cash flow, again, they've lost so much revenue, they've lost so much in the rate that the cash flow is going to be down. 142 million of free cash flow. So if, say we multiply that by 4, let's just say all 4 quarters are going to be the same, which is unlikely to be. That would give around 500 million of free cash flow, 600 million nearly. That's reasonable valuation based on that. That's 3 times free cash flow. So this isn't an overly expensive business. It's just a business with a lot of problems that the thesis has very much changed. This isn't an easy cash grab for massive dividends anymore. Cash conversion rate of 38%. That was again down 21% year over year. The balance sheet debt is increasing and cash is decreasing. So net debt $381 million. Now they have a sizable cash bank deposits and investment instruments way above the market cap, so it's trading below the cash amount, but versus the net debt, it's trading at a healthy premium to this. I think this graph just really illustrates what sort of freak conditions for ZIM end of 2021 and start of 2022 were, and are pretty much incomparable with where the business is going to be now. You can see that revenue down 63%, $3.8 billion of revenue, just revenue, they're unlikely to do that for the full year in my opinion. Adjusted EBIT has gone basically to nothing. Net income has suffered dramatically, and that is where the dividend is going. That's unlikely to come back for the next year or so in my opinion, meaning the dividend is unlikely to come back. Now, this is not an unsalvageable business by any means, however that's rough and they're no longer in the boom times. The guidance going forward is they see average freight rates continuing to be significantly lower than they were last year. Carried volume they're expecting to be higher, which is a relative positive if the rates are going down. If they can just get some volume up, perhaps they can improve the revenue numbers, and then using economies of scale, they can get the free cash flow numbers up. But this seems unlikely to me. This is a business that is going to be running at close or loss for the next year or so in my opinion, and they need that cash on the balance sheet to be going up rather than down. I think it's going to be going down for the next year. Dividends unlikely in my opinion. For this quarter, the cash situation wasn't so bad. The net change in cash was because of a massive debt service of nearly $500 million, so versus 174 of cash from operations and 142 of cash flow. That caused a massive change in the net cash position. Now, with capex being so low, it's likely they're not going to need a load of cash, providing they can get the debt under control. And when the net debt is only $300 million, that's not so much of a concern for me. I think this business is eminently has a lot of survivability. And they believe going forward that the recent demand trends are positive, in line with what they've seen in previous years. They're assuming 1.4% year-over-year growth in demand. 2023 volume is expected to grow from the current levels. Again, 1.4% year-over-year growth is not impressive at all, really. And even at this current valuation, I think this is a business that is kind of on pause, essentially. It's not going to be generating significant cash flows. It's not going to be returning capital to shareholders at any great rate. And it's not going to be growing revenue and profits. I've mentioned my scepticism on ZIM before, said that I'm happy to be proven wrong, but my opinion was that this was a challenge business from external factors, that the dividend may pay out for a quarter, but it's definitely not going to pay out for a year, and that's proven to be the case. I can't see the dividend coming back for a year or so until freight rates go up significantly, which I don't have a crystal ball, no one has a crystal ball, so who knows what's going to happen to freight rates, but until they go up significantly, this is not a business that can be paying anywhere near the dividend levels it was going to be paying, because it's just not generating enough free cash flow. Now, if he continues to generate in the $150 million range and gets his debt under control, which I would tentatively give it, say, 6 to 12 months to do, then yeah, maybe it could be reasonably valued at 3-4 times free cash flow, but that's not an unreasonable valuation. While it looks very cheap for this industry, it's a very commoditized industry. In good years, they can generate a lot of free cash flow. Many of its competitors who are better capitalised with better balance sheets, without this dividend overhang that there's the potential for a lot of shareholders to leave, in my opinion, now the dividend has gone, as we saw yesterday. There's just better businesses in this field and better fields than the shipping industry, in my opinion. Of course, that is just my opinion. You should let me know what you think in the comments down below. But right now, this is not an investable company for me. And I think now the dividend's gone, it's pretty clear to see this is a very difficult company to get behind for any reason. Now, of course, I'm not a financial advisor. You should do your own research and due diligence. Don't just buy, sell, or hold because I told you to. Capital is at risk at all times. Do your own research and due diligence and let me know in the comments down below what you think is ZIM. Do you think it has comeback potential? Do you think the dividend will come back in the near to medium future? Whatever you think, let me know down in the comments below. Like and subscribe and enjoy the video. I'll see you again next time.